Alrighty. Yeah, alrighty, we're getting there. Gotta play some music before we get going. And then we'll get going. Boom! How you guys doing? Almost ready. I got the chat up. Yeah, good morning, especially to you out on the West Coast. Man, it's early for you. Yeah. Where are you, coins and assets? All right. Let's mark this as the official start. Guten Morgen, everybody. Welcome to Forex.Today, the YouTube community. More than 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance. Yeah. All right. Why? Why would we want to do that? Well, because trading is risky, not appropriate for everyone. Your past performance, good or bad, not necessarily indicative of future results, but please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Hey, my name is Wayne. I'm a currency trader just like you. I'm a stock trader just like you. I'm an options trader just like you. I'm a commodities trader just like you. I own real estate just like you. Hey! I'm just like you. Very cool. So why don't we collaborate? That's great. That's the power of this community. We can share our minds like a Vulcan mind meld. And as they say in Holland, das is gut. Yeah. Gut. That's good. We do a good thing, us, you and me. So thank you for being part of this community. Thank you for your blood, sweat, and tears for years. Your loyalty and the respect that you show me every day. As they say, I like the way you trade. So thank you for being here. Besides these live streams every day, there are other resources that I'd like to point you toward. Trader's Way wants you to succeed. Most brokers don't. In fact, at most brokerage houses, if you happen to be a successful trader, they move you to a separate part of their book. They're like, oh my God, this person can actually trade. Really? Oh, let's get rid of that guy. Yeah, most brokers make their money by trading against you. They want you to fail. How do you feel about that? You like that? Make you feel good inside that you put your money in custody with somebody and they want you to fail? Trader's Way is different. They're an ECN. See the ECN? That means that when you place a trade, they put it into the interbanking system. That's it. So if they're going to have a successful business model, they need you to trade for years and years and years and years, which means they need you to be successful if they're going to be successful. That's called a symbiotic relationship. If you prefer that, why don't you check them out? That's all. There's no coupon code you need. There's no referral or affiliate link to click on. I don't earn a commission. Check them out. I also run an organization called Investor Bootcamp. I run an organization called TradePlans.ai. I run an organization called QuantBox. And maybe one day, I might have yet one more startup. Remember, I'm an entrepreneur. How would you like me to have a company, a service, provide you a service. How would you like me to provide you a service that uses artificial intelligence to do technical analysis? Oh, yeah, I'm looking into it, and what I've seen so far is pretty extraordinary. Yeah, pretty extraordinary. Yeah. Imagine it said, hey, did you see this pattern on Euro Aussie? Having seen this pattern on Euro Aussie 12,648 times, there's a 71% chance that this pattern will fulfill itself successfully over the next 4 hours. Would you like something like that? Pretty interesting. But of course, AI would have to be able to see it. And of course, if it sees it, it remembers every instance. It'll remember all 12,000 times it saw that pattern on that currency pair. Of course, we could never do that. Cool. Anyways, today's a big day. In about 15 minutes, we have our CPI number. There's going to be some base effects on it, so we got to be careful. I think you're going to get a mixed bag, high headline, low core, that kind of thing. Okay? High headline, low core, something like that. So that's going to be good and bad, maybe. Potential volatility there, of course. And then at 9:30, Bitcoin has an important moment in its history. It becomes legitimate for the first time. By legitimate, I define it as no longer retail, but now institutional investors that institutional investors have very specific mandates of what they can and cannot do. And up until now, most institutional investors, like I'm not talking about hedge funds, but like pension funds, insurance companies, banks, those types of guys and gals, they could not. They were not allowed to own any form of cryptocurrency. But we'll say specifically Bitcoin. Okay? Just couldn't do it. Wasn't even an option. So they have zero money in that asset class. So one person estimated that $6 billion could go into Bitcoin at 9:30 a.m. today. Just today. All these institutional investors are thinking, well, we should allocate, I don't know, at least 0.5% of our portfolio to crypto. Boom! Okay? And so, well, are they actually buying Bitcoin today? No, but the ETFs would be available for purchase. And they have ISIN numbers. So anyone, let's say, with the Bloomberg terminal could just go, boop, 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 boop. Now we have exposure to Bitcoin. Just like that. Easy. Buy it. They don't have to worry about custody and all that kind of stuff. And, well, that's part of the performance of investing into the ETF. And, all right, so it's great. In fact, 11 ETFs were approved last night. Members of Investor Boot Camp, we waited and got the news together live as a group. I had the SEC's X account up. They didn't even post it. We heard it on news. We heard it from one of the ETF managers before it was even announced. We knew. And then we watched it, right? So anyway, so what will happen is someone's going to buy some ETF today. And then the ETF has to go out and get some Bitcoin. And so indirectly, Bitcoin might have a decent day today. I don't know. But I'm in and I have a stop loss set and I have a limit set and winner, winner, chicken dinner. Anyway, so it might move today. I don't know the future. I don't know the future, but I'm going to be part of it. Okay. So anyways, to me, the Bitcoin thing overshadows CPI. Strange, right? So anyways, that's the news today, CPI and Bitcoin. All right, so we've already had some decent opportunities to buy the stock market, and it needs to come down before we get a new opportunity. Richard says, so you can't fundamentally value Bitcoin. Well, we know that there's a fixed amount of Bitcoin. And I would assume nearly 100% chance that demand increases today. By how much? Oh, I don't know. But billions would seem logical. And over the next 6 months, what, 100 billion? Maybe? That's only 10% of what Bitcoin is now, right? Bitcoin is what? What's its market cap? 900 billion? So let's say a 9% increase, right? 10% increase could, in demand. Increased demand leads to a higher price for the asset. As an asset. Now you might say, well, then there's this idea, but well, what's its purchasing value as money? Well, that's not really, all we're talking about is what's the market price of 1 unit of Bitcoin. And if the units of Bitcoin are stable, not, well, I suppose I can't use stable, but fixed. I know we have a halving coming up, but like there's a certain amount of Bitcoin. So if suddenly we get 50 to 100 billion dollars more demand for those same amount of Bitcoin, logic would dictate that its market value will go up. Its purchasing power may not, but they're kind of the same, but technically they're different. But the asset should go up in value because of the demand. Boom, good. Okay. So we're only at 50,000. If it goes to 70,000, I'm buying a car with my proceeds. So it's all set in stone. Whoop, whoop. No, it's true though. I got it all picked out. Yeah. 450 horsepower twin turbo. Nice. Move from the SUV back to a car. Anywho, so whatever. So that's what's going on in my mind today. That's the big thing. There's no big trends right now, but yen is on the move, and I'm sure you know all this. And so you need to start making decisions. They're quite elevated, but are you going to buy dips? Like, we'll just pick one. Okay. What's your plan on this? something like that. Yeah. Okay. So all the easy stuff. Yeah, my thought on the car, though, is to rip the exhaust off and take off the resonators, change the muffler, leave the cats on, of course. I want to be legal. But anyways, take off the resonators, okay, wider, what do you call the tubes? Whatever. And then a different mufflers on the thing. Because I want to hear it go, ram, pop, 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 pop. And then I want to hear the turbo whine. Because if you got twin turbos, I love that little turbo whine after the pop, pop, pop. And you're like, yeah. And I'm not even joking. Yeah. Yeah, I'm just a kid, I know. Ueda, just blah, 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 blah. Well, yeah, whatever. I don't see anything unusual happening with the yen, actually. Here's how I look at it. Somebody bought it at the pivot point. And now it should go up to 99. Okay? That's all. So Ueda said this and Ueda said that, but that's all part of seasonality. And that'll probably continue. Yeah. There are rumors that the Bank of Japan will raise interest rates at the April meeting. Okay. Okay. Is that right, Johnny? Yeah. That's cool, huh? So so that leads right to Johnny, like, are you going to buy the dip now? There's likely to be a dip. Let's move it over there. Okay. Oh, mine is, no, I don't have that. Mine says 101, Johnny. But this idea, hi, Highlander. This idea here is, are we just riding the 521 up? Yeah, probably. Is that right, Richard? Very cool. That reminds me, if you go to fxbootcamp.com, in your actual business. Hey, Forex trader, my name is Wayne McDonald, and I'm super excited to introduce you to the live performance coaching program here at FX Bootcamp. See, I started Bootcamp 20 years ago, and its core competency has always been live Forex training. This program, it might make you more profitable, it might help you refine your skills, but it will make you more of a confident trader. We need to break all those bad habits and replace them with standardized processes and procedures that give you control of your trading setup. It gives you, there's a whole article on pivots
in the way that you make your trades,
And because of this, you're able to identify your strengths and weaknesses as a trader and develop a real confidence in your actual abilities. So how does the program work? Well, the first thing we need to do is set up and schedule your one-on-one personalized coaching call. The second thing is you meet every single day in the live market to learn how to set up your trades properly. And third, every single week, you will meet live to review your trading performance. Again, to identify the strengths and weaknesses so that you can Anyways, awesome. FX Bootcamp is back, baby. Okay. We'll do an official launch soon, but it's up and running. There are meetings, right? Every day. Yeah. So we're about 3 minutes away. Let me get... you can refine your trading skills. I'm trying to get rid of that. All right. FX Street calendar. Let's use them. FX Street. Let's go to the indices. Here's sometimes I like to do this. So you can see the instant reaction. You go 1 minute. Now let's do 5 minutes. 5 minute. 5 minute. 5 minute. 5 minute. 5 minute. It's like a Genesis song. 5 minute. So take me home, 'cause I don't remember who. So take me home, 'cause I don't remember who. So take me. You're like, oh my God, is this a 20-minute song? Yeah. So I like year over year is what I like. That's core, and headline is here. So consensus is it goes up a little bit. So I'll blurt out the number. Richard, it's a 1-on-1 and then some on ones. It's very, very, very small group meetings. Okay. And then a private coaching call. So we want to know what you need to succeed. You're special, so we need to know. Don says, hey, wage data out of the Bank of Japan shows wages are slowing. So maybe not April. Yeah, like I said, it was just a rumor. Okay, should be just seconds away. All right, we're spinning. Whoa, whoa, I'm spinning. How quick the sun can drop away. And it's 3.4. It's up even higher than everybody thought. Yep. All right. But anyways. And then what? How did core do? 3.9. Yeah. Everything is up across the board. Oh, God. The Fed's going to have to not cut. That's what they're saying. The Fed's going to not cut. So we'll have to look at that. The stock market obviously is also going to come down. That's okay. We'll see. Maybe, again, if you've decided you're going to buy a dip, then you got what you asked for. Has it reversed on the 4-hour? No. I'm not going to be concerned unless, you want to know when I'm concerned? Here it is. If we come down to this 200 EMA, it's not the 200 EMA that matters. I'm just pointing it out. It just happens to be there. If we get a 100% retracement, okay, I'm going to change my behavior. Yeah. So the stop look and correct sessions are at boot camp for sure. So if this happens, then I adjust. I got to move and weave like a boxer. Okay? But my strategy currently, based on my bias, is that I'm okay buying this asset. I know it's not quite the right time of year and all that kind of stuff. I understand all that. But it's not bearish. So I can't have the fear of bearishness arriving. So the plan would be something like this. Somewhere around here, let's say, it goes up. So I sit and I wait. But, oh, did it just kill everything? Why did it just kill everything? Okay, but let me redraw it, okay? Based on that move here, oh, come on, Wayne. Wayne's having one of those days. Okay, there we go. Just one of those days. Yep, Limp Bizkit. All right. If it does that, then I'm going to change. On house is 618. Couldn't care less about a 618. A 618 is typically a buying opportunity. It wouldn't be on this 4-hour, but it would be on the daily. So that's also bullish. Okay, so we'll do it on this time frame. But if we do this, we're probably going to do that. So if we do this, I expect a different outcome. This is what I expect. Okay? And then I definitely need to change my behavior, right? Now, it could also crown, and crowning means this. And if it crowned, I would expect more like that. It's a small refinement, but it's important. And eventually we'd get to the future 200 EMA. So I'll guess the future 200 EMA would be there. Okay, so anyway, well, that hasn't happened yet, so why am I worried about it? I'm not worried about it, in fact. But I expect it potentially could happen. But it hasn't happened. So right now, let's say somewhat of a retracement, somewhat of an up. Okay? Depending on what time frame. If you're looking at it on the daily, you're thinking maybe the 50. If you're looking at it on a 4-hour, you're thinking more of a 33. See, I'm not using Fibonacci anymore. I saw a couple of quote unquote experts on YouTube, some gurus that were pitching hardcore Fibonacci. And their claims were outrageous. I'm like, that's so stupid. Do they actually believe it? Well, if they preached the way they were, and they don't believe it, then they're liars. But if they do believe it, well, then maybe they're just stupid. So I changed mine to 33 and 66 and 50%. None of those are Fibonacci numbers. Okay? So if anybody tells you that Fibonacci is required because it's just part of nature, and that you can make money trading Forex because Fibonacci, well, you know, if you look at the husk of a pineapple, its pattern is in a perfect Fibonacci ratio, and then just points to the fact that the S&P 500 is going to move in the same fashion, then your mother's going to be a disappointment because she didn't raise no fool. Huh? Don't be a gullible bull. Don't be a ninkau poop. Okay? So anyway, so I just changed it. 33, 50%, 66, 1/3, 1/2, 2/3. Works just fine. This has nothing to do with some stupid golden ratio. I just want you to know that. Doesn't matter. Well, Jeffrey, I'm not saying that they're broken. I'm just saying it doesn't matter. What matters? Are you going to buy a dip or not? That's it. Right? But yeah, I still use my Fibonacci study. I still buy dips. I just don't believe in some magical forces of the universe contributing to the success of your trading. Dude, if you can't buy a dip, that's your problem. Not your Fibonacci, not your Fibonacci setting. Okay? You can trade without any indicator. Some are helpful, some are important, most are irrelevant. Okay? That's all. I'm just trying to break down this belief system of magic. Yeah, magic. Yeah, it's a measurement device. I also happen to use it to do projections. And I have something, of course, that nobody else uses. So look at, let's do this. This is, delete. I wanted a color. There we go. This is not a Fibonacci number. This is not a Fibonacci number. This is not a Fibonacci number. And this is not a Fibonacci number. Jim's like, but I want to believe. Yeah, totally. Well, that's when you see these guys hardcore selling their secrets and stuff like that. I'm like, oh my God. And, for someone that's maybe desperate, they need to hear that, right, Jim? They're like, if I only knew the magical forces of the universe, that will make me a success. No, the hard work will make you a success. The discipline will make you a success. Yeah. Okay, so anyways, it dropped to the 21 and held. Oh, good. Good. Bitcoin holding steady. We're waiting for the 9:30, so there's one more hour. Jordan's like, grit. Yeah, grit. Well, really, and low leverage. Like, if we really want to get into it, so like the professional hedge fund managers that I know that trade Forex, they're smart. There's no doubt. They're experienced. There's no doubt. Grit? I don't know if that's the right word, but they they have a lot more experience than people in our live stream today. They have more experience. Many of them have pretty good education, not all. And they have a general idea of fundamentals. Yeah, they're okay. But technicals are okay, but you'd be surprised. You'd be surprised. A lot of different trading strategies don't really need the technicals that much. They do rely a little more on fundamentals, but not always, but generally. But the one thing in their smart, sophisticated process, let's say, whatever the strategy that they're employing is that they have significantly, how about extremely less leverage than you do. So you're rolling in with 50, 100, 200 to 1 leverage, and you're failing. But institutional investors don't trade like that. They just don't, and they make money. How many institutional investors don't make money? None of them. They all make money. So what do they do? What is one clear difference? You're jacked on Mountain Dew. Your trading is jacked on Mountain Dew. You're like a spider monkey. And they go to work and they make money. If they have a bad month, it's not a big deal. A bad month, it's not a big deal. They're like, it didn't work out this month. Oh, too bad. Einstein's management fee makes a difference. Yeah, but those are going away pretty quickly. And compliance costs are skyrocketing. So really, that's just... So like a typical hedge fund charges $220. That's dropping closer to 1 in 10. I'm thinking... when I launch my hedge fund, one of the ideas I'm thinking is, can I do it right and have the right incentives and cover my costs if I charge a 0.88 and an 8.8? So fees have gone from 2% to 1%. I'm thinking, can I do less than 1%? Can I do less than 10% performance fee? And so that's the direction there. But you do make a point. The other thing is they don't need leverage because they have a lot of money. Right? And so maybe it helps. But I know hedge fund managers that they don't get really a penny of the management fee. It's just for running the business. Like, let me give you an example. Do you think your hedge fund gets audited by an outside auditing firm like Ernst & Young, KPMG, whatever? Pick your firm. Do you think that happens? Frank says, well, how much percent does the hedge fund need? Well, this is what we're talking about. Do you think investors and regulators would demand an outside audit once a year? How much does that cost? Yeah. Well, Richard's, it's like a standard lot is 100,000. That means you need 1,000. If you're leveraged 100 to 1, yeah. Here's the thing, though. There's different uses of the word leverage. Okay? So, let's say I'm leveraged 100 to 1. and I have $1 million in my account. So I buy one standard lot. And that, because I'm leveraged 100-1, I utilize 1,000, right, for my margin. Now you come along and you have $10,000 in the account. You are also leveraged 100-1. And you can also take 1,000, leverage that up to get a standard lot. We have the same leverage, right? We're both leveraged 100-1. Which one is taking less risk, me or you? Which is funny, right, Mr. Right? The way I asked it, if you said you, that's wrong. Me. But yeah, but you see what I mean? So it's not the leverage that's available, it's your trading that puts you at risk. Yeah. Okay. To me, it doesn't matter if you have 50-1 or 500-1. It just doesn't matter. Okay. If you're a hedge fund trading Forex, you're not using 50-1 leverage. No way, Jose. So anyways, there is a difference, and you can have bad months and survive quite easily. And most people hear a bad month is a 30% drawdown. And you're like, oh my God, you could never be an institutional investor. So there is a massive, 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 massive difference. And that's usually what it is. They're not typically, I mean, look, like I said, and I'm thinking of my friends, of course, they're smart, they're sharp, they're talented. There's no doubt. Like they're good people, but you might be good people too. I don't know, right? But they're not significantly, let's say, different, I would say. Well-spoken, good-looking, well-dressed, making money. Yes. Probably educated. But again, like real-world experience, they've learned as professionals. So they might have worked in a bank for 10 years or 20 years. And, so, and now they're out on their own. Okay, good. But they know what they're doing, but you know what you're doing. And in fact, in many ways, and I'm not joking by this, and I'm not exaggerating by this, in many ways, you have significantly better skills. But they have, $25,000 watches because they're not over leveraged and they trade professionally. Yeah. Something funny happened to me about, probably almost a year ago or 9 months ago. I was on a Zoom call with one of my buddies, and I said, I forget what it was. I had a watch. I'm like, look, right? Look, I got a new watch. Or maybe he noticed it or whatever. But I'm like, look, I got a new watch. And he's like, oh, I got a new watch, right? So I show him $1,000 watch, and he pulls out his $5,000 watch. And we're like, oh, that's nice. That's really nice. And his trading partners, because they're all on their trading desk, they're all nearby. And when the Zoom call was over, they're like, dude, were you flexing your $5,000 watch? They're like, dude, that's bullshit, right? And one guy, he flexes his, and it's like a $10,000 watch, and then the other guy flexes his, and it's like a $20,000 watch, right? And they're like, and it's just like boom, 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 and there's a chain of command. But the point is, look, they are savvy, they are smart, they are experienced, but so are you. So one of the greatest mistakes that seems to be apparent is that you're extraordinarily over leveraged. And for newer traders, they just don't know. Over time, though, you'll realize that the lot size being so big is a form of risk, and risk is bad. And so what professionals do is try to reduce the risk and increase the time. See, you only have two choices because you start with a certain amount of money, whether it's $5,000 or 5 million. There's not a lot you can do to change that in the beginning, right? So what's the next thing that you can control? What do you want to emphasize more? Okay, time or risk? Well, if you increase risk, it's because you're trying to minimize time. You're trying to get rich quick, but it's risky, and it probably, mathematically, will not work. It's like going to Vegas to get rich. Probably not a good strategy. Well, the other one is, well, why don't you lower risk? Well, then you'll make money. It'll just take a lot longer, significantly longer, but it's likely to occur. So which one do you want? Not likely to occur, but if it happens, it'll happen quickly, or likely to occur, but when it occurs, it'll take a while. Which one are you emphasizing? So I've been preaching lower lot sizes, lower levels of leverage, consistent trades, consistent behavior, letting your winners run, keeping your losses small, not even being afraid or embarrassed about your losses. In my book, I actually say, take pride in your losses. So probably everything you thought you knew about trading and investing before you and I developed a relationship is probably wrong. And we have to turn everything around. Those that are ashamed of their losses will never be a professional institutional trader. If you emphasize reducing the amount of time it takes to make a lot of money, you're probably going to fail. I mean, that's not even my opinion, right? That's just math. Be interesting if you spent some time trying to mathematically figure out how you're going to succeed. And you might look at your trading and say, well, I can't figure out how to do that mathematically. Then you're not trading properly. For example, what if starting today, every trade you made had a 100 pip stop? Would you have to lower your lot size to afford that? Yeah. Okay. What if your stop was 150 pips? Would you have to lower your lot size even more? Then we're on the right track. We're on the right track. Yeah. Now, what should your target be? Your minimal acceptable performance on something like this? On Hell says, no, but always on Hell. Even if you had $1 million account, you would still, relative to the account, have a small lot size. Yeah, 2 to 1, 3 to 1? Yeah. So now you have, okay. That's Pip. Boy, I'm going to sneeze. Hang on. Oh, excuse me. Yeah. See, I might actually be getting sick, right? On target. I'll put target. Now, what if you only... Thank you. What if you did only that? Well, I bet you not only would your lot size be less, because it takes longer for the trade to work out, you also trade less. Because you can't add more trades if you have 2 or 3 losing trades, right? So you're going to trade less with smaller lot sizes, but you're going to stay in longer. I just fixed you on a free live stream. Okay? Done. You're welcome. Yeah. But that's not even the smart part. What if most of your trades fail? What if most of the time you lose 150 pips? What did we just learn about your trading? Because you're not going to get unlucky. There's rarely going to be a situation where the market drops 150 pips to knock you out unexpectedly, right? No. What if most of them are losers? What did we learn? You'll still be consistent and disciplined, but what if you're consistently losing? Now, yeah, you might still actually eke out a profit, but you're going to be dissatisfied. Yeah, Mr. Right. Yeah, but see, that's just the proper math. That's what I was saying before. If you can't mathematically figure out your probabilities, then you're doing something that's probably not going to work out. It's because you don't know what you're doing and you're inconsistent. You don't have a process or procedure. Lucas says, yes, your analysis is wrong. He's a gentleman, so I'll say it differently. Your strategy sucks. But you got the setup and the math at least right. If your strategy was correct, 150 pips should be more than enough. And you're letting it run on the 2 to 1, you'll be fine. But if most of the time it fails, son, you don't know what you're doing. You're a mess. Okay? But what if you're a great trader but have no consistent tactics? Well, it probably won't work. What if you're a mediocre trader but you have a proper strategy? Yeah, it'll work out. The logic of the trading will probably prevail over your skill. There you go. So Jimbo says, hey, WMD. He said he was busy last year, so he basically did swing trading. Did this by default. Well, I've been preaching it forever, right, Jimbo? And last year was up 250%. Yeah, well, you caught some trends, and you rode them out. You learned how to trade, Jimbo. Yeah. Jimbo, you owe me a $5,000 mentorship fee. Yeah. Send it to my PayPal. Yeah. Yeah, good job, buddy. Yeah, that's it. Now you're a trader. You do that for a couple of years, you're going to be able to raise some money. You're there, man. You just did it. You just had your breakthrough. Well, the thing is, it's just a more prudent strategy, more reliable strategy. But the other way of looking at it, and this is insulting, but I'm trying to appeal to the psychological part of everyone's brains here. Okay, so I'm speaking to you emotionally. Okay, you all know the reason you're here is what you used to do sucked. So at some point, you really have to focus on not doing what you used to do. Because if what you used to do worked, you wouldn't be listening to some idiot on YouTube. So, good. So sometimes you need to do something simply because it's a change, but then you got to measure and test and adjust. You still have to apply the scientific methodology. So if you're stuck on your 5-minute chart, your 15-minute chart, and you react to green candles and red candles, and you've tried every oscillator on the planet, and you've adjusted all your moving averages, and you've been trying some Elliott wave, and nothing's working, then stop doing it and listen to me. I'll make it more simple. And we'll use scientific methodology and math that scares most people. Well, do what most people can't do or unwilling to do. Yes. Well, so Jimbo says trade less. Well, then you make less money. Well, not if you have let your winners run. Well, but then now you need to know things like fundamentals and trends and global money flow. Yeah, so you end up making better, smarter trades that last longer and are worth more. Your trading is worth more. So it's not trade less, it's just make your trades worth more, but not on the account of risk. So if they're not worth more because you've jacked up your leverage and lot size, then how do you make them worth more? They have to make more pips. You can spend all day trying to make 25 pips, or you can spend all day trying to make 250 pips. Okay? The interesting thing is the 250 pip one takes less time. Okay? Yeah. Proper trading takes less time. So if you spend too much time in front of your charts, let's fix that. I don't say you have to get rid of it. If you're like a scalper, I was talking about this yesterday, you have some really awesome skills that you're going to be able to really use and really benefit from, right? I don't mean to poo-poo on scalpers. I think it's a really good skill. But you need to increase your repertoire, okay? You might be wicked with a 5-iron, but you're probably not going to win golf tournaments. Okay. So anyways, this is great. Now we're less than a half an hour away for maybe potentially an interesting move. Of course, as this goes up, I'm afraid, I'm not worried about saying that this just drops like a ton of bricks because nobody's thinking it's going to do it, which means maybe somebody takes advantage of it and they do crash the market. So that's what I'm scared about, but I got my stop jammed. I might be able to move it up a little bit so that I literally can't lose money. And what everyone is hoping, and that's why we're vulnerable, what everybody is expecting is a pop. And we go to the next level, faux show. We're going to 50K or above. We're on our way to 60K. If I get to 70K, I'm buying a BMW. If it drops today, I get out at break even and my Bitcoin turns to cash. Cool. Yeah. Yeah, Jim's right. I understand what Richard's saying. Scalping and day trading is purely technical. And then Jim says, not necessarily. And yeah, not necessarily. You can scalp and spot and day trade over and over and over again in the direction of your fundamental bias. That's what I've been teaching for 20 years. Okay, again, think about the book, Strategic and Tactical Forex Trading. The strategy is the fundamentals. The tactics is your technicals. So Jim's right, it's not necessary, but you could, Richard, scalp, spot, and day trade on purely technicals. You could, but it'd be very difficult to let any winners run. Yeah. Yeah, well, I do put it that way, Richard, for 20 years. Oh, it's funny. Yeah. Oh. All right, well, we're back to the spike high, guys. Back to the spike high, 48. I'm in at like 44 and a half. Going for 70. 71, I think. I was laughing at myself earlier today because I adjusted my limit order. What I did is I calculated the price of the car, the price of the taxes, the prices of the plates and the insurance and the shipping of the car. So I know exactly what the car is going to cost me, and I moved my limit order to that number. Yeah. So it's in a weird place, but anyways, you never know. You never know. It's got you guys know this one, the Bang & Olufsen Bang & Olufsen stereo system. It's like a $5,000 stereo system. Upgrade over the $2,000 stereo, right? So I don't know, it's like a $7,000 stereo in this car. I'm like, oh, that's cool. So anyways, come on, Bitcoin, let's go. How much leverage do I have? None. No leverage. I could. So there's no news now. CPI already came out. It's just the open of trading at 9:30 for the first time. Institutional investors that have billions and billions, hundreds of billions of dollars, will start buying Bitcoin through these 11 new ETFs that are there's like 11 IPOs today, all around Bitcoin. Money is going to go to these, is my thought. And then those ETFs have to buy Bitcoin with the money. So I'm like, hey man, I don't know if this pops and has a great day. I'm going to buy myself a treat because I just talked yesterday about only a fool would buy a car on credit. And in fact, rich people So like the next thing is then you only buy a car with cash. Yeah, but I like to invest my cash and own assets. So I'd rather an asset. So what I said yesterday was someone that has 7 Ferraris probably got each Ferrari for free. Would anybody like to know how to get 1 or 2 or 3 exotic cars for free? How truly smart people do it? Poor people would spend money or lease it. Even worse, they'd lease it. They're like, Wayne, it's $3,000 a month. I can afford that. Yeah, you're poor. You're probably not saving for retirement. You're probably not putting your kids through Ivy League school. You probably, so how do you do it? Okay. You buy an apartment building. Or drug money, right, Osamu? Yeah. But how's the right way to do it? All right. You save your money and you buy an asset with it. The asset I typically use, maybe it takes you time. Look, it always takes time. But at some point in your life, you decide to buy an apartment building. Cool. Who pays the mortgage? Okay. So you collect the rent, you pay the expenses, okay? Then you get your net operating income, rent, money in, expenses, money out. What's left over is your net operating income. Then you pay your mortgage, which we call debt service. It's your monthly mortgage payment. Okay, you're servicing, you're paying down your debt. So you got to minus the debt payment. And now you have return on investment. Yes, there's like taxes and stuff that you would also throw in there as well, but let's just keep it simple. Okay, NOI and then ROI. All right, cool. So you do that, and every month, because what you do is you get this, it's a mortgage. So this debt is a mortgage, mortgage, okay? And it's amortized for 30 years. Just like the mortgage on your home. So what they say is, okay, if this is a $10 million apartment, a $1 million apartment, remember the bank is putting up 70% of the money. You see that? 70% of the money is not even yours. So maybe in the beginning you buy a small apartment building. I don't recommend buying a second, third. I have a friend who owns, I think it's 7 houses besides the one he lives in. And, anyways, it's not my preferred way. I'd rather own one apartment building with 7 apartments than 7 individual houses. And trust me, everyone that's ever owned a house and put renters in it has a nightmare story. I know for a fact one of his houses burned down and he had to rebuild it. Like, dude, these are problems. So more houses, more problems. One apartment building, one problem. But I know people that own apartment buildings. I had one of my buddies, he's like, I'm in Ohio. I'm like, why are you in Ohio? He's like, I own an apartment building here, and some idiot drove his car into the building and went into the basement and broke some pipes. Like, oh my God. Like, he hit the building so hard, right? That it went through, opened up one of the small basement type windows where the laundry room is. Or suddenly is 6 foot wide. You're like, oh my God, right? So anyways, it's always a problem, but this is why you get paid. So anyways, so you get this mortgage and it's amortized over 30 years, which means you make one payment every month. And interest is already calculated in it. And if you do this every month times 30 years, okay, at the end, you owe the bank zero. But here's the thing. The bank doesn't want to take a 30-year risk. So the bank amortizes it like you're going to have this building for 30 years. But then they're like, look, after 5 years, we need to renegotiate. We might want to raise interest rates, but you might benefit and we'll lower interest rates. But the bank can get out of the deal and you'll need to go find a new bank to finance the next 5 years. So this is what's a major difference between residential properties and commercial properties. And your apartment building is commercial. Okay, so you're going to get a mortgage. They'll give you a 70% of the money, but in 5 years, you need to re-up. Kondo says only in America. America, when you invest into real estate properly, it's designed to make you filthy, stinking rich. And yeah, other countries don't do this. Yeah. I mean, there's so many crazy, unbelievable benefits. Dude. Okay. So anyways, we'll go back to here. So how do you get your Ferrari for free? So the economy is good. Let's say you bought it, you got a deal because you bought during a recession and interest rates are low because the Fed had just slashed interest rates. Pretty normal, right? And what happens to the value of the property during a recession? Well, the value of the property falls. So that's why you get a deal. Why does it fall? Well, some people lose their job because the economy is bad. So now you have 20% vacancy. So now your rent is low and your expenses are fixed. So this property is not even profitable. This is why the owner has to sell it because he's now losing money. All right. So anyways, because he's got the high mortgage, right? So anyway, so you pay less because it's producing less income. It has all these fixed expenses. So you buy it now and you get it at a lower price and you get it at a lower mortgage payment. So suddenly it's profitable again, but you're the new owner. 5 years later, the economy has recovered and it's doing okay. And you're back up to 95% vacancy. And your rent is stabilized and your income is great. And interest rates are starting to creep up again. They went from slash and burn when you bought to suddenly normalizing again. Not a big deal. But you go to your bank and you're like, hey, it's been 5 years. I need to re-up. And they're like, ooh, well, you have more people renting from you. So your cash flow has gone up. Your expenses are still fixed. So we're going to increase the value of your property. Meanwhile, for 5 years, the renters have paid down the mortgage. So now the property value has gone up and the mortgage has gone down. So they're like, yeah, we'd like to do this deal. So now your total mortgage has fallen, right? So you have two choices now. You renew the mortgage at the new. So let's say if it went from $10 million and I don't know, I'll make up a number. Okay. And so now your mortgage is now $9 million because the renters have been paying rent for 5 years. That's just the mortgage. But the value has gone up. So they're like, we're going to value this at 11 million. So what the interesting thing is when you get to this rollover point, whether it's this 5-year rollover or the next 5 year or the next 5 year, but the numbers get bigger the more you delay. But let's say you do this right away. Right away. The bank says it's worth 11. Okay. The mortgage is 9. Okay. You could put, right? You could re-up this. I know the numbers don't quite work out the way truly. Like if you've invested in real estate before, you're like, Wayne, these numbers don't make sense. I know. I'm just using them as a model, but in general, in principle, what I'm showing you is actually what happens, right? So you just re-up the mortgage back to 10 million again. But the property value has gone up, so it's still a little bit less risk-wise. The renters are still paying the $10 million mortgage. You haven't sold the property, so it's just the debt to equity ratio and all that changes, and it's favorable, and the bank just wants to do the deal. And so what you end up doing is, and let's say this number is just too far off. I can't believe this. Okay. Your new mortgage is not 10 million. Your old mortgage started at 10, you drew it down to 9. So you tell the bank, I want a $9,500,000 mortgage, okay? Or if even that is too hard to believe, okay, let's make it even more realistic. You're like, okay, we paid it down. The new mortgage will be $9,750,000, okay? And now you have a new mortgage. The value of the property is going up, and you're going to need to refi this in another 5 years. So after 10 years of ownership, you're going to have to do it again. So you just put $250,000 in your pocket. You haven't mowed the lawn or anything. Okay? You haven't done anything. Except you're the owner on paper. The rent comes in. You probably have a manager anyway, so you pay the manager a little bit of money. Okay? So the rent comes in. The manager collects the rent, pays the expenses, the gardeners, the insurance, the water bill, the electric bill, saves some money in case you need a new roof or change the windows, or when a renter leaves, you paint the walls. Okay, that's great, 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 great. And so after 5 years of you doing nothing, you go out and you buy a Ferrari. 5 years goes by, now you have 100% fully rented apartments. The economy is booming. Everyone's got money, so you jack up your rent. Now you have an increased cash flow. Meanwhile, every month the renters pay down the 9.75 mortgage. They pay it down to 9 million again, or 8.75 probably if we go with the same level. Actually, rent is increasing, so they drop it like down to 8.5. Is right? You've amortized the mortgage. But because you've raised rent and you're fully occupied, the value of your property has gone up again. Now it's worth 13.5. So you sell the property. Huh. You sell the property. You have an $8,500,000 mortgage, 8.5 M. We'll just call that an M. And you just sold it for 13 M. Winner, winner, chicken dinner. Pay your taxes, yada, yada, yada. But you can buy another Ferrari and now a house. A nice house. And it's because poor people, right, paid down your mortgage and bought you a Ferrari to thank you. And then poor people gave you more money and pushed up the value of your ownership, the property itself. And then you sell it at the top of the market. And then 2 years later, we hit a new recession and occupancy goes up, cash flow falls, rent gets slashed. The new person you sold it to has a high interest rate mortgage because they bought when there was inflation, and that person loses. So now you wait for that. So 5 years or 7 years after you bought the apartment building, it's now dropped in value. Someone can't afford it because they have the high interest rate loan. We're going into recession. 30% occupancies. You go in and you buy it cheap again. You just have to understand economics and monetary policy and business cycles. And of course, the average Joe doesn't, so you need to be above average. That's all. Okay? Okay? Technically, I minored in real estate at Harvard. It's not a minor because it was my master's degree. It's some sort of, so like I have a master's degree in management and finance, right? So there's management. I have a management degree with a tilt on finance, but I also, having done the studies, I completed everything for the real estate. I think that's true. I might have been one class off and there was no point in spending thousands of dollars. But anyways, the idea was I can't have a master's degree in management with a tilt on finance and real estate. But then I'm like, but what if I do all the requirements? And I think there was one more class. And I'm like, I want to take this class. And they're like, well, you can take the class, but we're not going to give you sort of the designation. I'm like, but I want the designation. And they're like, yeah, but you can't have two. So do you want to be management and finance or management and real estate? I'm like, no, I want finance. In fact, I want to pretend I'm English and say finance. It makes me sound smart. And so I'm like, but I have serious interest in real estate. Like, it's really, 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 really cool. Okay. And I didn't even play a game on the amateurization. There's a whole game to it. Oh my God. So this is like, I'm not going to go into the big speech. I'm actually waiting for the open in 2.5 minutes. But this is why Donald Trump is accused, or one reason he's accused of being a liar. They're like, you're not a billionaire. You don't make any money. Money is for poor people. You have to understand the concept. And by the way, when I say poor people, don't get all pissed off at me. Okay? Wealthy people don't have any money. Okay? There was even a time, like in England, that it was said that a gentleman would never carry money. First of all, everything's done on credit, and your lawyers pay the bills. You just go, you want a suit, you get a suit, goes on credit. They just know you, they write it down, and then your attorney pays for it later. And then you want to eat at a restaurant, the restaurant just writes your name down. You're a British gentleman in London. You don't carry cash. Cash is for poor people. You're like, money? I don't have any money. Money is filthy, right? So anyways, this idea instead is Trump doesn't earn a salary. He doesn't get a W-2. Okay, so how can he be a billionaire? Because he has amateurized the assets and you just keep it. There wasn't even a distribution. You collected rent, you paid your expenses, but you depreciated some of the value, which lowers what you need to pay in taxes, so you just keep more. So he never got any money. He never got a salary. He never got a distribution. He collected rent, paid the expenses, but one of the expense was depreciation. So after collecting all the rent and paying all the bills, and there's just like an extra $1 million in the building that is just his. But if you don't understand that concept, then you don't understand, like, how could you be a billionaire and have no money? You have to change your whole concept of the world. Oh my God. And it's weird when he gets accused like that, because all it's doing is showing that the people doing the accusations have no idea what they're talking about. And I don't mean politically, I mean in that one instance of, he must be a liar because he says he's a billionaire, but he doesn't make any money. Every single one of his businesses loses money. Yes, that's the game. Jesus, Murphy. It's the basic tenet of owning real estate. You don't want to make money. You make your money through depreciation, which is tax-free, by the way. So that's the other thing. They're like, well, you're a billionaire, but you don't pay any taxes. Of course, that's why you're a billionaire. Remember, the amortization is an expense. It's like a write-off. So instead of paying taxes, the rules allow him to just keep the leftover million. There's no tax paid. He didn't earn any money. There was no income. You see? It's just there. It's leftover. Oh my God, right? So how about this? So let's say he owns 100 buildings, each doing this. So each building pays him $100 million a year, let's say, okay? Tax-free. Okay? Cool. When he dies, he can give all 100 buildings to his children. Trump Jr. And they don't pay a penny in taxes. Not even a penny. When a poor person dies, half of whatever's left over goes to the government. When Trump dies, none of it will go to the government. So like, well, why don't you just do that? That's the funny thing. People, right, point and fingers, rich people are bad. Well, why don't you just be rich? It's so much better. You're like, well, Wayne, now you're poking fun at me. No, I'm not. So Bitcoin is open, okay? So I'm watching it. I'm like, no, you just need to play the game. I'm trying to make you aware that there is a game. And there are rules to the game. But the game is a good game. So how do you get there? You're like, Wayne, I don't have a lot of money. There's no way I'm ever going to own an apartment building. Well, not thinking that way. So how do you want to change your behavior? And of course, you'll want to know more knowledge. So you're like, what are all the steps I need to do so I can do stuff like that one day? I'm writing a book on that. It's not even about real estate, but it's something that can be done. But if you don't know, then you're like, you're saying these billionaires are evil people because they have all this excess capital. And how could Trump never pay taxes? How come Trump never makes any money? But he flies in a jet plane owned by a company. Gets driven around in a limousine owned by a company. These are expenses. Why are none of his buildings profitable? Because he depreciates up to the value of 0, which is allowed in the rules of the game. So he doesn't make any money, has no income, pays no taxes. All of his investments are break even or losing a little bit of money. And he gets to fly around in a private jet. He gets to drive around in a limousine. He sleeps in a $50 million apartment, and he ain't got no money. So again, this isn't a Trump speech. This is, hey man, there's a game, and you're allowed to be in it. In capitalism, we don't care how tall you are, what sex you are, what race you are, what religion you are, who you make love to. No, nobody cares about that stuff. It's like, hey man, this is capitalism. Let's be productive. How do we make money, right? I mean, it's not that, but I'm just saying, this is the land of opportunity. Now you're like, you don't have real estate. You have Forex. Look at this, making money on Bitcoin as we're watching, right? You have access, but this is only your first step. Do you understand that? So again, I'm writing a book on how to go from poverty to being rich. How many people here want to go from poverty to rich? poor to rich. That's just the first step. Okay? Yeah, well, the next step is wealthy, but you can't become wealthy if you ain't got no money. So you got to get rich first. Rich means you have a lot of cash. But we also know cash is trash. Poor people don't have any cash. So we got to go like, how do we build a track record of success that in turn translates to money? How do we get you from you ain't got no money to now you have plenty of money? Then we got to move you from money, cash is trash, so we got to get rid of it. And really what happens is most people stay in poverty, they just have a lot of money. So they have a big house, they have a fancy car, they have a beautiful watch, and they're broke. They're leveraged. We were talking about how leverage is bad. They have a huge mortgage. They pay $1,000 a month for their sports car, and they still don't have any money. They're still poor. They just have high income. And one day they're going to die broke. They were born broke. Somehow, by hook or by crook, they got money, and now they're burning it like crazy. They're burning it. And they'll die poor again. So now you have to go from poor to rich to wealthy. And so you got to break all these different, right? You got to break all these different vicious cycles that hold you back. And for some reason, in America, you're not allowed to talk about things like money. So nobody knows anything about money, except people that are already wealthy. Very few people become wealthy because nobody knows how to do it. And once you have it, you keep it. Okay? I do know people that inherited millions of dollars. So like the thing is, are you trying to use Forex to make a lot of money so you can buy a Lamborghini? Or do you want to learn money and finance and economics in all these different industries so that when you die, you leave your children $2 million in cash or assets that produce cash? And now they can just live on the cash flow of the assets. I'm telling you. So we're talking about you have to make a choice. Right? Increase risk to reduce time. And I suggested that was bad. What if you and I sat down together and we made a 200-year plan? I've even suggested a 300-year plan, but 200 is enough to start. Do you think you'd behave differently if you had a 200-year plan versus you want to get rich quick? Well, the time I've stretched so far out, 200 years. It might change the way you talk to your children. We had sort of like a family meeting the other day. So my son has opened up a retirement account. My daughter has opened up a retirement account. Okay. And I said, my wife and I say to our children, we're going to give you $1 million each. How many people would love to give their children $1 million each? Now, the caveat is they can't touch it until they're 55. If they wait until 70 or 65, I think it's more like 70. If they don't touch it till 70, it could be as much as 1.5 to 2 million. How many people would love to know quite certainly that they can give their children $2 million each? How many people would like that right now? I'll tell you how to do it. I'll tell you how we did it. Anybody here can afford it. Okay? First of all, my children are teenagers. They're teenagers. They have retirement accounts. That's the drop mic moment right then and there. Okay. So we're starting a process where we give them $50 a month each. And they're like, whoa. Step back, Wayne. You said you were $1 million, maybe $2 million. Okay. $50 a month, compounding at 12%. If you don't believe in that, change the compound to 10, whatever, do you? This is what I'm doing. $50 a month when they're, right, let's say 20. Let's say they haven't even started till 20. And you hold for 50 years, right? Every month, $50, compounding for 50 years. It's well more than $1 million. It's significantly more than $1 million. See you on hell. Yeah, it's time to go. Look at that. My Bitcoin's making money. I'm smiling ear to ear. But anyways, that's how you do it, guys. Isn't that interesting? More than $1 million each. It's done. It's done. Just that one little account. And that's just my contribution. My son is already putting $500 a month. So if the math works out right, he will have 10 million plus my 1 million. And that's just one of his retirement accounts. He doesn't have a career yet. He's a teenager. So now, later on, he's going to go to university. I'm going to put him through university. Great. And then he's going to get a good job, and the job's going to give him a 401k, yet another retirement plan. So it'll reduce his taxes. Great. And then what? They'll do a match. More free money. So he'll have his little personal savings account, a Roth IRA, and he'll have 11 million into that. And then this other one, if he saves prudently, it'll have millions from his career and the free money. And then there's other tricks to the trade to make it even better than that. Like, it's insane. Okay? But I grew up poor. Right. So Sal is like, well, if you're wealthy, that's not a big deal. But I grew up poor. Poor enough where I lived in public housing for a short amount of time. Poor enough where we didn't have food to eat. Poor enough where my mother would sit down. She didn't teach me how to be rich. And I say this with great affection and pride. She taught me how to be poor. So she taught me budgeting. We would sit down, my mother and I. My father didn't live with us. It was just me and my mom, so single parent. And she didn't have much money. And we sat down. And, well, first of all, she ended up owning a house. And then a couple of houses. But at that time, we were young. And she found a way to own a house. So she owned a house. We didn't rent. So that was a big deal. But then we would sit down and like we had things like, and I'm not even joking, we have $5 this week as a family. How should we spend it? Nice. We have the phone bill and the water bill and the electric bill. and we don't have enough money to pay it. So how should we handle this situation? This is what my mother taught me. It's wonderful lessons, isn't it? But we never talked about me going to university. A retirement account, tax planning, wealth. No, she taught me how to survive poverty. So that's where I started. Right? So anyways, I thought I've learned a few things over the years by talking to very smart people. And then I ended up getting a half-decent degree, right? A couple of half-decent degrees. So I've learned a few things over my life, and I will put this onto paper because I think only the 1% know this stuff. It took me a long time. Took me a long time, right? So I'm still learning because I'm still inquisitive. I'm always trying to find a better way because I'm an entrepreneur. So cool. So I think it'll make a really interesting book. And I hope you do too, because I want somebody to actually buy the book. Otherwise, it's a waste of time. But the book will allow me to do things like go on lectures. I can go on tours. I can talk. I can do podcasts. And I can teach people what people don't know. And I think that's another contribution to making society better. And that's inherently what all of this is about. Not just the book, not just our talk, us. We meet every day, us. This is what you and me, are all about. So I've been doing live streams for 20 years. That's what that is all about. Okay? So, cool. Thank you for being part of my life. Peace on earth. May the pips be with you. May your profits be above average. Cheers.